Hi there, and welcome back to Energy Flux on Air. I'm your host, Seb Kennedy, founding editor of Energy Flux, the energy newsletter analysing European natural gas and global LNG markets through the lens of Europe's energy transition and global geopolitics. Well, at the risk of sounding like a broken record, we've seen yet another absolutely crazy week in natural gas markets in Europe. The last week's crazy price movements saw a rapid reduction again in the front month price on TTF, that's the Dutch Title Transfer Facility, the benchmark trading hub for European gas prices. And I would say that those price movements were predominantly the product of shifting outlooks on the regulatory landscape in Europe. And I spoke at some length about that in last week's episode, and also the way that investment funds misread a communication from the European Commission about the EU's natural gas refilling targets. The regulatory angle is vitally important for the reasons I explained in the last episode, and I'll be speaking a little bit about the regulations around natural gas refilling on today's episode. However, I suspect we're moving swiftly back to a place where geopolitics, rather than regulation, takes the lead in driving European natural gas prices. And I've spoken at length about the huge influence of investment funds, that's hedge funds, on price movements on TTF, and how attuned these hedge funds are to geopolitical developments. Because we have this situation, this unholy situation, you might say, where you have multi-billion euros worth of speculative capital taking massively significant directional bets on TTF, and the funds are reacting in extremely exaggerated ways to geopolitical developments. They really do overcorrect on every utterance, every headline, every tweet or post on X, every newswire data point that comes from the Trump administration, from peace talk with Ukraine, from position statements from the Kremlin, from rumors about what European member states might be saying to the European Commission in Brussels. And there were just so many earth-shattering geopolitical events hitting the markets day after day, hour by hour. These events are breaking at warp speed. So you have this concentration of extremely significant headlines hitting a market that is already excessively attuned to geopolitical developments and is taking these enormous market-moving sized bets on the directional price of natural gas and influencing price outturn. The result is just phenomenal volatility on the European natural gas hubs and natural gas prices, and all of the kind of second-order effects that are implicit in that. So this lethal cocktail is really distorting how energy markets price risk. And another problem that we have right now is that the geopolitical backdrop to energy markets is harder than ever to read. Just take, for example, I'm recording today on the 10th of March that Russian troops are encircling Ukrainian forces that are occupying the Kursk Oblast. They are making potentially devastating advances to encircle those Ukrainian forces. And a notable aspect of this is that Russian troops were able to actually to advance without detection by Ukrainian forces by literally creeping through a segment of a disused gas pipeline that used to be used to export Russian gas into the EU via Ukraine. So Russian assault groups used the perhaps ironically named Brotherhood pipeline to successfully infiltrate behind Ukrainian positions in Sudza, which is just over the Russia-Ukraine border on the Russian side, effectively cutting Ukrainian forces in Kursk in two. And the timing for this is interesting because the Trump administration seems to have withdrawn and then partially reinstate military support to Ukraine, but also more significantly flip-flopping on the sharing of US intelligence with Ukraine. And the White House seems to be signaling that US intelligence is another bargaining chip that it's using as leverage against Ukraine in the evolving ceasefire talks with Russia. At the same time, energy geopolitics more broadly is bordering on the absurd. If you consider how the US and Russia are working against their own energy interests to the benefit of each other, the situation is quite mind-boggling. So take, for example, that Russia's bombardment of Ukrainian energy infrastructure is targeting the country's natural gas production facilities. And this targeted campaign of destruction was leaving Ukraine without gas at a time when Ukraine itself has rather depleted natural gas held in storage. So that's compelling Kiev to turn to US LNG to fill the gap. Russia's bombardment of Ukraine is essentially creating demand for US LNG. And at the same time, the Trump administration's rapprochement with Moscow is opening the door for Russian pipeline gas to return to Europe at the expense of US LNG. So Moscow is promoting US LNG while the White House is promoting Russian pipeline gas. It's incredibly topsy-turvy and quite difficult to really get your head around. One way the Russian pipeline gas might return to Europe is through the Nord Stream pipeline. One string of that Baltic Sea pipeline, which runs from Russia to Germany, was not damaged in the 2022 blast that saw the Nord Stream 1 and part of the Nord Stream 2 pipeline destroyed in a subsea explosion. So there's a lot of discussion now around the future role of that one string of the Nord Stream 2 pipeline, which has a carrying capacity of about 27.5 billion cubic meters per year. 27.5 billion cubic meters of gas, that's about 1/3 of Germany's total natural gas consumption per year. So Nord Stream 2 could play a massive role in the future direction of natural gas markets in Europe and hence globally as well. And the White House is actively exploring options to ease energy sanctions against Russia as part of its mission of appeasement, frankly, to appease the Kremlin and to pave the way for some sort of ceasefire deal that gives Russia everything it could possibly want, and some sort of grand bargain that sees the White House and the Kremlin allied in their mission to essentially carve up this post-Ukraine new world order. And the Nord Stream 2 pipeline is a part of that. We're seeing reports emerge that the American investors are looking seriously at taking stakes in NS2 to have economic upside in the resumption of Russian gas flows into Europe. And that could be one way that a compromise deal is reached on the conflicting interests of Russian pipeline gas and US liquefied natural gas in Europe, because obviously the more Russian pipeline gas enters Europe, then the less space there is for American liquefied natural gas. And that's one of Trump's massive economic priorities and foreign policy priorities, is to increase European purchases of liquefied natural gas from America. And he's using that as a bargaining chip in his attempts to levy tariffs against Europeans. He says that buy more US LNG or you'll face a trade war. Well, it's going to be hard to do that if Russian natural gas is entering the Central and Eastern European states by pipeline in a massive way. And I'll talk a bit more about that once we get on to the reader questions. So we've had quite a significant number of questions for this episode. Again, just a reminder that I do prioritize questions from paid subscribers. So if you want to have a question read out on air or just an observation, I'm open to comments, either named or anonymous. Then just send me a message in the Substack app. First of all, be sure that you're subscribed to the newsletter. Go to www.energyflux.news, where you can sign up for free or paid email updates. And once you've done that, you can message me in the Substack app, where you can submit your questions for the next episode of the podcast. So starting off with questions from paid readers, we've got one from Nikos, and it's all about geopolitics. How could geopolitics affect supply in Europe? 4 questions. The first one is, will some pipeline gas be established? That's Russian pipeline gas. And if it is, what is the TTF premium that will be discounted? And he follows that up with, how would prices react to a full withdrawal of Russian energy-related sanctions? Well, I think that in terms of the risk premium on TTF that would be removed from the resumption of Russian pipeline gas, well, I mean, we've we've seen quite a big risk premium added to TTF as Russian pipeline gas has been successively reduced. It's not completely gone because Russian pipeline gas continues to enter Europe indirectly through Turkey via the Turk Stream pipeline under the Black Sea. But it is, a tiny fraction of what it was before Gazprom started unilaterally reducing gas pipeline flows into Europe in 2021. In advance of Russia's invasion of Ukraine. So the TTF premium that would be reduced from a resumption of Russian gas pipeline flows is really going to be proportional to the amount of gas that actually returns to Europe. And I'll elaborate on that in a moment. But Nicholas asks about how would prices react to a withdrawal of Russian energy-related sanctions. Well, that would also be very bearish for prices because the Arctic LNG-2 project, which is an enormous Russian liquefied natural gas project in Russian Siberia. That is the most sanctioned Russian project of all. The Arctic LNG-2 project did start exporting its first cargoes at the start of last year, but these cargoes, they loaded onto vessels, but then because of the threat of or the imposition of secondary sanctions, then buyers refused to buy them, both in Europe and in Asia. And a lot of cargoes ended up sailing all around the world and being dumped into storage facilities, which are controlled by Russia at either end of Russia's extensive landmass. So nobody was prepared to buy cargoes from Arctic LNG-2 because of sanctions. If sanctions are removed as part of the kind of sweetener for a ceasefire with Ukraine, then you will see Arctic LNG-2 come back into service because that plant was shut down because it couldn't find any buyers. There was nowhere to put all of this liquefied natural gas that it was pumping out into the market. So it had to shut in. It has one train that is operational or potentially operational, and the second one is under construction. So it could, in theory, be ramped up to 2/3 of its maximum rated capacity if sanctions were to be lifted. And of course, if sanctions were lifted, then that would also probably resolve the remaining impediments against being able to build out the third train. So Arctic LNG-2 would ramp up to 2/3 and then probably keep building out, commissioning, and then ramp up even further to full maximum production capacity without the sanctions preventing them from doing so. All of this will be very bearish for global LNG prices because Arctic LNG-2 is designed to supply both Europe and Asia via the Northern Sea route. Nikos goes on to ask, would the Americans allow or endorse the re-establishment of pipeline gas to Europe? Doesn't that hurt their LNG interests? Well, I touched upon this earlier, and yes, but they seem to be working to promote each other's interests, Russia and America. Like I mentioned, maybe American interests won't be limited to LNG. Maybe American interests will also have an economic stake in Nord Stream 2. It sounds like a pipe dream, but the world has gone through the looking glass so many times now that really anything is possible, and it's hard to rule anything out as being a mere pipe dream because things that would have been even more of a pipe dream are happening right now. So who knows where this will end up. That said, I do think a more realistic outcome is that Russian gas won't return to the pre-2022 levels, mostly due to a lack of commercial arrangements to allow for this volume of gas to be traded into Europe. And the reason for that is that European companies, EU companies, not member states, are the ones that buy gas from Gazprom. So even if Europe is forced to accept a ceasefire deal that has been hammered out basically to the exclusion of Ukrainian and European diplomatic input, you still need to have a contract with Gazprom to import gas from Russia. And the EU might have to accept a political agreement, but they can't be forced to sign contracts, and that won't be part of the ceasefire negotiations. They have to be bilateral contracts signed between European utilities or industrial gas consumers in Germany, for example, and Gazprom. So it's difficult to contemplate negotiating and signing long-term contracts with Gazprom, particularly when there are outstanding arbitration claims against Gazprom from European energy companies that have been upheld at arbitration proceedings. Several billion euros worth of debt over non-delivered gas that's unpaid, and it's really hard to see a European company signing a long-term gas purchase contract with Gazprom and just waiving those debts. And it's equally hard to see Gazprom actually paying those debts. So that's something of a sticking point. So my view is that a most likely outcome is that smaller volumes of spot sales, those are kind of one-off opportunistic sales of gas from Gazprom into Europe, which Gazprom used to offer up until about the sort of first or second quarter of 2021. They periodically would offer additional gas to the market in response to demand. I think we might see that come back potentially if Russian gas is going to come back at all into Europe. It will probably be in that commercial format rather than in the format of very, very large scale long-term deals. So that kind of smaller amount of kind of top-up gas, spot gas, that would strike some sort of a balance between allowing Russian gas to return, but without pushing US LNG out of the mix altogether. So you have a kind of compromise there where, both Moscow and Washington are able to kind of hold aloft some sort of economic win for each side, while sort of carving up their energy interests in Europe. Nicholas had a fourth question. He said, could the Americans offer a government-sponsored long-term offtake price in barrels of oil equivalent to the Europeans that mitigates this conflict? Or does the production and ownership structure of US gas make such arrangements less likely than with, for example, Oman or Russia? And I would say that that's not really going to be possible because the US LNG space is entirely privately owned and operated. There is no direct state ownership of American gas liquefaction capacity, and it's all very atomized as well. So you have lots of individual investors, listed companies, each owning their respective stakes in natural gas liquefaction capacity along the Gulf Coast. And it's very hard to see them being kind of corralled or controlled in that way by some overarching political agreement, because you don't have a state-run energy company that owns controlling stakes in any of these projects. Grandiose political accords, which we've had in the past, and there was one agreed between the European Commission and the Biden administration in March 2022 to improve European energy security by Europe buying lots of US LNG. That was just political window dressing. It didn't really actually result in any more LNG from America ending up in Europe. The market decides where the LNG goes. And even if Europeans have a kind of take or pay sales and purchase agreement with US LNG projects, then the cargoes are still sold on what's called a free on board basis. So those cargoes get shipped around the world, and wherever they get the biggest net back, so the biggest profit, whether that's in China or Japan or India or even South America, then they'll go there. And, Europe's been basically the premium priced market for most of the last 3 years as a result of the war in Ukraine. So the market's been signaling to send American cargoes into Europe, and that's where they've gone. And it wouldn't have paid the difference if the Biden administration or anyone else had signed some sort of political accord for Europeans to buy more or less natural gas from the United States. It's the market which decides. On a related note, the European Commission has flagged taking ownership stakes in US LNG projects. This is a bad idea for many reasons, not least because it exposes European buyers to massive market risk and potentially renders them as bag holders if the market for natural gas loosens and turns south and prices soften. Then by owning a stake in a liquefied natural gas project, you go from being a spot buyer to being a seller, essentially, and you have an interest on the sell side. And that doesn't seem to make a lot of sense because the liquefied natural gas market is almost certainly going to tip into looser market conditions towards the end of this decade. And the idea of turning yourself into a seller at the point when the market is on the cusp of turning into a buyer's market would seem to be counterintuitive. Okay, moving on. Another question from a paid subscriber, anonymous in this case. This reader, they quoted back a section from a recent article of mine called "The Bear Roars," when I discussed the massive sell-off in TTF gas futures. So they quoted this section from that article, which reads, "Targets or no targets, Europe still needs to refill its depleted gas storages. To do that, it must attract marginal LNG cargoes from a variety of global exporters. The deeper the TTF correction, the harder that task becomes." That was That was what I wrote in that article. This reader's question was, shouldn't the TTF price eventually rise to a level sufficient to attract LNG if commercial undertakings add buy pressure to meet their fill targets? Or is the worry that such an effect might be too slow or delayed to capture sufficient LNG volume until winter? I would say that yes, TTF will always rise to a level required to attract the marginal molecule. Europe has to refill its gas storages. So the regulations are important, but at the end of the day, the gas storage levels are low, but not critically so, and but they have to be refilled. So in order to do that, Europe has to pay a price that attracts the LNG into European terminals rather than Asian or South American terminals or anywhere else in the world that needs the LNG. The question is, when does it have to do that? And what's the strike price, if you like? And that's what the market is really struggling to decipher at the moment. Now, the EU's sort of quasi-relaxation of gas storage regulations recently has kind of muddied the waters in that regard, because it's like the regulation still stands, but the Commission put out a recommendation which still needs the approval of other member states. But essentially, there was this kind of word salad, this mixture of reinforcing the message that the regulations have not changed, but at the same time explaining all the ways in which the regulation can be sort of bent and massaged and almost ignored, because there is no penalty for there is really no penalty for not complying with it. From my understanding, this recommendation, that this text that the Commission put out, it was, as is so often the case in the European Union, a kind of massive fudge. You had lots of conflicting interests from different member states. You have different views about, the pros and cons of having very strict refilling targets. So they've tried to kind of have their cake and eat it by saying, yeah, the regulation is not going to change, but there are all these conditions in which the regulation can essentially take second place to things like difficult market conditions, because obviously at the moment we have this situation where natural gas is being priced more expensively in the summer and less expensively in the winter. So you have this inversion of the spread. Normally the spread is positive. You buy cheap gas in the summer because supposedly gas is cheap when demand is low and people aren't using it for heating, and the price is high in winter because that's when demand is higher, because the colder months mean you have less solar generation and power, and gas is needed more. And the presence of these refilling targets over the summer, or these intermediate filling targets, and then this kind of end destination of 90% by the 1st of November has really distorted the market. The investment funds know that the strategic gas storage operators, they need to buy certain volumes of gas, and they've taken these bullish positions over the summer months accordingly, which I've talked about previously. And they've inverted the spread. So you have gas is more expensive to buy in the summer, which is when you have to buy it to put into storage. And then if you hedge that by going short in the winter, when you most likely be using the gas, then you're essentially locking in billions and billions of euros of losses, because you're buying high and selling low, because that's the way that the market is primed at the moment. So yeah, this kind of relaxation of the regulations was intended to address that problem. The Commission did for the first time acknowledge that the spreads were inverted, and that this was a real problem, and that they wanted to do something to address that. But it's not really clear they've done that, because the spreads, they remain inverted. Summer gas is still more expensive than winter gas, so there is still no incentive to actually refill at the moment. And it's really, really hard to tell how that's going to evolve, because the message from the Commission is the member states can essentially do whatever they want to get to 90% by the 1st of November. And reading between the lines, the message is that you don't even need to get there. And they do actually outwardly state you have an extra month if the market conditions are particularly adverse towards actually buying and storing gas. Then you can easily just let it go until the 1st of December to hit 90%. And at the same time, even if you don't hit 90% at all, it's not really clear whether there's any actual financial penalty. The only concrete measure, or the main concrete measure that seems most likely to be taken, is the member states are free to subsidize and pay for the procurement of gas over the summer, inflated prices, and then heap that cost onto consumers, which Germany had proposed doing, and then
walked away from because the market participants essentially told them that this is unworkable. But the option remains for countries to subsidize the losses implicit in restocking gas in a market that's been distorted by these very targets. So this situation makes it very hard to trade. I mean, my reading of it is that, the strategic storage operators are essentially going to postpone the refilling program as long as possible, kind of safe in the knowledge that the interim targets, the targets between May and September that are supposed to kind of plot a trajectory up towards 90%, those interim targets are essentially meaningless. They are there, but they're sort of targets in name only. But the destination is kind of, you've got to make your best efforts to reach it, even if there's no real penalty. So they're going to make their best efforts to reach it, but they'll do that, I imagine, by postponing the procurement of gas in the hope that essentially gas becomes cheaper the closer the 90% by 1st of November deadline approaches. And then if it becomes impossible and gas becomes more and more expensive, then maybe they'll look at just kind of capitulating and either buying gas and hedging at a loss and then asking to be made whole by subsidies, or perhaps just breach the refilling targets altogether. And this is something I did flag at the end of last year, that I thought that there was a wild card in the deck for the European natural gas markets, and that was the behavior of the strategic storage operators. I did flag the possibility that they would simply throw up their hands at the European Commission and at their respective governments and say, look, we can't comply with these targets. I did flag that as a potential outcome, that they might just say, well, we can't reach 90% because the market is essentially going to bankrupt us if we do comply with the legislation, and we are not mandated to make a loss, even if you might regulate for us to do a certain thing. If it's going to cost us millions or billions of euros, and we won't do it, and that's a possibility. We'll see. So I think what's going to happen is you're going to have this sort of standoff over the summer with the storage postponed as long as possible, but the longer it's postponed, then the more risk builds up in contracts that are late summer, early autumn, and even the winter contracts after the 90% by 1st of November deadline itself. So I'd imagine that the safest bet for the investment funds is to position aggressively their bullish positions in October and then increasingly in the November contracts if it becomes apparent that the 1st of November target is going to be missed. I will see. So much could happen between now and then. We really have no way of being sure. Now, moving on, I've got some questions from free readers as well. Those previous questions were all from paid subscribers. So I'm going to fit in as many of these questions from free readers as I can. One from Roman Doroshenko. He says, hey, so great content. May I propose a question for the next podcast? Could Brent-linked pricing become more popular in Europe instead of, or at the expense of, TTF or other European hub pricing in the 2026 to 2028 period because of much larger size, liquidity of the oil market and its lower volatility? And I imagine that this is referring to the pricing of liquefied natural gas contracts that are signed. And Roman didn't elaborate on where this pricing would apply. But so will new LNG deals be priced according to Brent, which is much less volatile contractual structure, because Brent indexed LNG contracts tend to be they're priced off a slope to Brent, so it might be like 10, 11, 12% of Brent, or the average price of Brent over like 3 to 6 months, and there might be a time lag of 3 months or so, and you have a kind of constant, so it might be like 12% of Brent plus $50 cents per MMBTU to have a kind of more rounded and less volatile price. Certainly for the buyer, then that's potentially more attractive when the market tightens to have exposure to those contracts. But like I said at the start of this podcast, it's really a swings and roundabouts thing, because if the market is about to tip into oversupply, which many commentators are saying it will, and I probably count myself amongst those, starting at the earliest in the sort of first half of 2026, and certainly as we go towards 2027, we're going to see significantly looser market conditions prevail, in which market pricing is going to be a lot lower. Well, if you're on Brent-linked pricing at that time, then you're not going to be reaping the rewards. You're going to be stuck holding take or pay of Brent's 12.5% Brent parity with a 50% constant. It doesn't sound to me like that's a particularly attractive prospect when you're on the cusp of looser market conditions. But at the same time, these contracts they are signed for, at least sort of like 10, maybe even 15 or 20 years. And over that period, then it's entirely likely, if not inevitable, that we'll see another period of market tightness. Some people say in the early 2030s, particularly Shell said that in its LNG outlook, that there would be another tight market period after the glut, when you need more liquefaction capacity to keep up with kind of surging Asian demand. I'm not sure if I buy into that narrative, but it's a possibility. And if that happens and you're holding Brent indexed liquefied natural gas, then you're going to be laughing, because if the whole world is scrambling for gas molecules in the 2030s and you've got access to cheap long-term contract gas, then and you're going to be at a competitive advantage to your rivals. So maybe if you're playing the long game, you sign a long-term contract during the kind of loose conditions, and you get a really attractive Brent slope, like a really low percentage, like 9-10% Brent, and you lock in then you could be setting yourself up for happy days in the 20s. And that is one thing that I flagged in a recent series of deep dives about the LNG glut. It was called Sizing Up the LNG Glut, and I did say that the LNG sellers, they really hold the key to whether the kind of coming glut of LNG is going to lead to more sort of sustainable or more volatile market conditions. And if they agree to sign long-term contracts at lower Brent parity pricing, then you could argue that you might find a semblance of balance in the market in the 2030s, because essentially you've managed to reconcile the price that sellers need to sell at to cover their costs with the price that buyers need to buy at to remain competitive. And there's a very narrow window between those two extremes, and LNG has really, like over the last 3-4 years, priced itself out of the market for so many importing regions, precisely because Russian gas has been excluded from the market for mostly geopolitical reasons, but also, of course, the decisions taken by Russia and Gazprom in the lead up to the invasion of Ukraine. So yeah, there is an argument for Brent pricing. It depends, I think, a lot on the willingness of the sellers to stoop to the price that the buyers really need, and to essentially give them that gas over a long-term period at the prices that are attractive to them. Okay, moving on. Don't want to spend too much longer on the last questions, but there are some really good ones. Ryan Simpson. Absolutely fascinating topics. Thank you, Seb. A few topics I'd love to know your views on. Do you think the EU Commission can do anything to limit speculative positions? This is the speculative capital, of course, investment funds I've talked about. I'm conscious that more intervention in the market can yield negative results. Would speculative plays reduce if the EU removed storage targets? Would this lower gas prices for customers? There is some movement to tighten position limits, I'm told. I've not seen any kind of concrete moves in that regard, but it is being discussed. But I'll just kind of reiterate the point that removal of the storage targets, the gas storage for targets, would not in and of itself end speculative plays. Because even if there was complete market-based pricing, market-based procurement of and management of gas storage facilities, you buy according to the forward price of gas. It doesn't remove the fact that Europe still needs to buy lots and lots of gas and lots of LNG to refill its storage tanks in time for next winter. So you can't say that, the removal of the storage targets removes speculation. It just makes it much harder to speculate, because you don't have, if you're like trying to position bullishly, you don't have like a concrete end target day like the 1st of November to reach 90%. So I'd say speculation would still be ever present on Dutch TTF, but it just makes it a bit harder to time the bullish trade, which I've discussed earlier. Ryan carries on. He says, what is your position on Russian pipeline gas returning to Europe? Do you see a deal being brokered between the US, Russia, and Europe? Again, I've already discussed this in some detail, but my base case is that I'd say that no, I don't think any lasting ceasefire deal will be brokered, because Trump's approach to a one-sided deal that excludes EU and Ukrainian interests is simply unsustainable. And of course, Russia will not honor any ceasefire. I just don't believe that they will. There is lots of historical precedents to demonstrate that. So I think that this kind of Trumpian policy of appeasement towards Moscow is going to fail. If there is like some sort of unlikely ceasefire brokered, then, like I said, I think Russian gas would return only in the form of spot sales for the reasons discussed earlier. And he carries on, any consequence of the US becoming a less trustworthy ally to Europe. We are set to depend so much on them for LNG. Do we have a choice to make here? Well, there are immense consequences, Ryan. You and I know only too well that go way beyond the scope of gas, LNG, and energy. More broadly, I'd say the security implications are absolutely immense from the US becoming less trustworthy. We're seeing European capital being mobilized in a big way for this defense spending. That's already happening. And, transatlantic trust has been utterly destroyed, and that won't be easy or quick to repair, even if there was a change in administration in the White House tomorrow. It's just the damage has been done. Say, like, in terms of like the choice, what choice does Europe have to make? Europe's choice is as follows: to the extent that it depends on natural gas, then it's like, how much do you want to depend on US LNG, and how much do you want to depend on Russian pipeline gas and Russian LNG and LNG from other sources like Qatar and other places? It's like, how far do you want to tip the scales in one direction or another? Having a mix of suppliers is always preferable to being excessively beholden to one than the other. And it's worth remembering that LNG was often seen and used as a means of holding Russia and Gazprom's feet to the fire in the renegotiation of long-term pipeline contracts, because Russia had just such a massive market share in the sort of noughties and twenties in Europe that it was very easy for them to just say, well, okay, the price is this, and European utilities had to sign up. It was like, take it or leave it. There wasn't really much of an alternative. And as with the onset of LNG, then of course you had a diversification of supply sources, which allowed European utilities to go off and sign these long-term or even just spot procurement and just say, look, I can get LNG more cheaply than you're supplying it through the pipeline. So that acted as a kind of cap on the price that Russia was able to charge for its pipeline gas. And it's worth noting here as well that, this whole myth that Russian pipeline gas is cheap is a complete non-starter, because for that very reason, like, Russia abused its market position for so many years in Europe. And as a result, LNG was really a kind of a welcome means of introducing some much needed competition into the European natural gas space. So I'd say that, to the extent we rely on gas, those are our choices. We've got to just kind of diversify our sources. And that has been a long running European policy, is to, import gas from diversified places like Algeria, like Azerbaijan, and from Norway, of course, and the UK, North Sea. It needs as many sources as it possibly gets to increase diversity, supply security, and to keep a lid on prices as much as is reasonably possible in the circumstances. But I'd say that there are options that go beyond that. It's not just about diversifying your sources. Gas demand reduction, in my opinion, should be placed on equal footing as defense spending, because the events since 2021 really demonstrate the hidden costs of energy dependency. So Europe really must double down on any and all measures that reduce import dependency, particularly. So, that means redoubling efforts to shift away from gas heating and in residential properties, and getting heat pumps and e-boilers into as many homes and buildings as possible. And, again, like, improving and making funds available for improving the energy efficiency of buildings to reduce the overall heating demand. And the decarbonisation of industrial processes, which is extremely complicated and expensive, but ultimately, for the long play, very much worth doing. So, trying to replace natural gas in steel smelters, absolutely vital, but by no means a very easy thing to do. Europe needs a kind of all of the above energy policy. It needs more solar, more wind, more nuclear, more geothermal, and I'd even say more domestic oil and gas production, to the extent that there is any unexploited reserves to be developed in Europe. It's always preferable to be developing domestic resources than relying on imports. And I really think that the last few years have shown just how dangerous and costly it is to rely on, quote unquote, cheap imports from non-aligned allies or non-allied trade partners in energy. I think that Europe should be supplying long-term supply agreements with Norway. You've got to keep Oslo happy, and Norway's not particularly happy with its energy trade with the EU at the moment. It in fact has caused massive political repercussions in Oslo. Norway is importing volatile EU pricing because of the way that the single market operates in electricity. So I think that signing long-term supply contracts with Norway would be probably politically advantageous, keeping Norway on the side with the EU. And it would also help to kind of ward off the decline in Norwegian offshore gas production, because the last thing that Europe needs is for Norwegian production to start entering terminal decline, because Europe's not quite ready to wean itself off gas that quickly. And Norway is obviously a friendly, local, and very, very, very low carbon supplier of the fuel, certainly compared to US LNG, Russian pipeline gas, and pretty much any other source of gas you care to name. And now, this is already a very, very, very long podcast, but I want to move on to my last question. And this is a really great one from Adrian Heel from Energy Cities, which is a Brussels-based NGO. He says, "Hello, Seb. First of all, many thanks for your work in explaining gas markets to the masses. I have a question for you, and I'm hoping you might indulge me. Fair warning, it might be a really stupid question." No such thing as a stupid question, Adrian. Would it be possible for the US and Russia to corner enough of the global LNG market to drive up prices significantly if Trump invented a pretense to economically, or even physically, with the US Navy, shut down gas exports from Qatar and Nigeria? Would that be enough to allow the US and Russia to form an LNG OPEC? What if they targeted Australia? Would that be enough? Trump's economic attack on Canada makes it clear that he really doesn't care who gets hurt, Americans included. He cares about power and seemingly benefits for Russia. Controlling the global LNG market seems like a really effective way to have power and benefit Russia, as well as trashing Europe and, I guess, Japan too. Anyways, maybe there is enough LNG globally that he couldn't do such a thing. Very curious what you think about this entirely speculative question. It's a real mind boggler, isn't it? The way that allegiances are shifting, Adrian. And I'd certainly say on the kind of broad question of concentration of market power, that is a structural problem in LNG globally. There's a very small number of suppliers, really, compared to the number of buyers out there. So you do have this potential for concentration of market power. And the rapprochement between Washington and Moscow makes this seemingly possible to consider, this idea of them cornering the market, or at least kind of in an abstract sense. It makes you think, well, maybe they could do that. And, conversations are underway, and there are media reports and analysts already talking actively about a potential grand bargain between the US, Russia, and Saudi Arabia to fix oil prices. And there are reasons to imagine why that could or could not happen too. And I'd say that there are loads of constraints to it happening in the LNG market. The pushback would be quite considerable, not least because, US plus Russian LNG is not really enough to corner the market, because in 2024, the US exported 87 million tons of LNG, Russia exported 33. That amounted to about 30% of the global total, according to data from Kepler. So you can't really corner a market if you only own 30% of it. And the idea of shutting down other suppliers, the consequences would be just absolutely catastrophic. I mean, shutting down Qatar essentially would involve the US Navy occupying the Strait of Hormuz, which is something that Iran periodically threatens to do when it's being threatened by the US. And it's kind of hard to see Washington and Tehran aligning on that strategy. Even if they were to do it, then that would also imply a kind of shutdown of 1/3 of the global oil supply, which would be massively inflationary. It would completely implode the global economy and lead to a absolutely huge recession, if not another Great Depression. So fundamentally, my reading of it is this. If Trump was to try something as utterly, utterly mad as this, and I wouldn't put it past him in terms of thinking that he might try this, but if he was to do it and he was to think about it for more than 1 nanosecond, which he may or may not be capable of, then he would forever be remembered for triggering the greatest depression in living memory, and possibly even World War III. And I think that not even Trump, his henchmen, and the useful idiots in the MAGA movement could come up with enough lies to scrub that simple fact from the history books. Being remembered as an abject failure would simply be too much to bear for this preening narcissist. That's all he really cares about, isn't it? It's about how people perceive him, getting the ratings, being praised and idolized. And it's kind of hard to do that if you literally destroyed the global economy and triggered a war that could essentially wipe half of the world's population out of existence with a nuclear war, which could potentially arise from trying to dominate the market in this way. So, it's having said all that, it's kind of hard to conclude that Trump will be remembered for anything other than abject failure judging by the way his current negotiating strategy is playing out. I mean, he's acting like he has all the cards. He's acting like he can swagger around, like he can lord it over the world and bully everybody and just prove that American might will always prevail. But, like true strength in global affairs comes from soft power, really. Yeah, you need to back it up with hard power. But by kind of dismantling all of the organs of soft power and just going for hard power and just saying, right, we're going to fix oil prices, we're going to corner the LNG market, we're going to deploy the US Navy to massively promote our economic interests. That is absolute kryptonite for American power over the long term. There's a reason why US AID existed. There's a reason why US diplomacy has operated in the way it has. And there's a reason why the US is able to exert the hard power that it wants to exert now. It's because it was actually acting predominantly by exercising its soft power capabilities and by leveraging alliances, which the Trump administration is systematically destroying. So it's very hard to see how American dominance is able to sustain on a global scale for very much longer if Trump carries on in this manner, regardless of whether or not he actually does try to do what Adrian suggested and corner the LNG market. So I really, really like that question. Thank you, Adrian. And thank you for listening. I know it's been a very long one. But I do enjoy these Q&A sessions, and I want to always try and get as many of them in. There were more questions. I'm very sorry if I didn't get to your questions. It's just impossible, and I don't want to give you too much listening to do. But thank you. Thank you for listening. Thank you for reading and for subscribing. Don't forget, if you are listening to this through Apple or Spotify or somewhere, then don't forget that this is the podcast of the Energy Flux newsletter, which you can read and subscribe to for free. Go to www.energyflux.news, sign up for free email updates. And if you want to get a question and you want to make sure it gets featured on the next podcast, then take out a paid subscription. You get access to all the paywalled posts, the entire archive, hundreds of posts, loads of data viz, loads of graphics, loads of really, really original, quite edgy analysis of the way the European energy and natural gas markets are evolving in these completely crazy times. So do sign up and support independent energy analysis in the process. That's it for this week. Thank you so much for tuning in, and I will see you again in about a week's time.